Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio, we have Paul Norris, Managing Director and Head of Securitized Products at Conning, to discuss emerging areas of structured credit that investors should be paying attention to. Paul, it's great to have you with us. Welcome to Trade Talks.
Thank you so much.
And structured credit, it means different things to different people. What are 2 to 3 areas of the greatest interest at this time, and what emerging areas are you paying attention to?
I would say 3 areas that are really interesting right now are, 1, consumer credit. There's been a lot of talk, of course, of a recession that was going to happen or maybe happen, and consumer credit would have been at the forefront of that. And so a lot of investors have been paying attention, watching delinquencies in consumer credit, but really nothing's happened at this point. So that's one area that the market focuses on. The second, I would say more exciting, is the new economy, the digital economy. We see things which maybe we'll talk about in a bit, but data centers, fiber optic, music receivables, all things that are kind of greasing the skids for the digital economy. And then finally, when we talk about structured credit, commercial real estate really is sort of the big elephant in the room that drives a lot of conversations about what's going to happen next.
Right. Well, I mean, commercial real estate, I mean, there's so many different subsectors of that.
True.
Some are performing, like to your point, data centers earlier.
Yep.
But some of them, you know, like office, for example,
Yes.
still continuing to struggle. So it's a big umbrella, right? CRE.
Yeah, CRE is a big umbrella. Certainly there's great sectors. We would say, you know, medical type of buildings or data warehouse or even warehouses in general have done fine. But when you focus on office and maybe multifamily and some other sectors, certainly office has seen a tremendous amount of weakness, and it's something to follow for how it's going to impact banks and others within the economy.
How does structured credit perform in this environment of rising interest rates and, you know, stubborn inflation?
Right. I'll throw aside commercial real estate, and we'll talk about that maybe later. But generally, things like commercial related assets like container or rail cars or equipment have done quite well. They still continue to perform very well. The flip side, consumer, we talked a little bit about. Consumer has seen its performance in terms of delinquencies rise back to that 2019 level, which I would call benign. It's fine. But we've certainly, within our portfolio and looking across the world, we've seen a real divergence between subprime consumers and prime consumers, where that performance is really starting to diverge.
What factors drive demand for structured credit, and what problem does it look to solve?
Demand is really driven, I think, by a simple formula, and that is that it offers a yield and spread over competing assets. So you could look at munis, you could look at corporates or treasuries, obviously, and structured credit offers a meaningful yield above those, even though it has a same or better credit rating. So the example I would give is, today we can buy structured credit, generally speaking, single A, at yields better than triple B corporates. And we view that as a great relative value.
So what are some of the risks associated, or do you see any red flags on the horizon for structured credit?
No red flags, certainly, given where we are in the economic cycle, a lot to watch. We talked about consumer. I think consumer really bears watching quite a bit, just to see that turn. I think what investors are watching consumer for is sort of to divine when the economy might be going into a recession. That's an early warning signal. Real estate is the other big one. I think that's really tough because there are a lot of unknowns in that market that could roll over and impact other sectors of the economy.
Yeah, but I mean, if you look 6 months out into 2024, if the labor market remains as strong as it is, I mean, that's certainly going to be a tailwind for the consumer, and perhaps nothing really changes there.
I would agree, and I think one of the things we watch is, quite frankly, digital, in terms of digital phones or cell tower receivables, where we see delinquencies there. Now, if we were to see delinquencies pop up in that sector, everyone needs their phone. They're always going to pay their phone first. So we think that would be a telltale sign that maybe the consumer is finally weakening. And to your point, we haven't seen that at all yet. So most consumers are frankly doing quite well.
All right, appreciate the insight, Paul. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.